short calls and even short call spreads, we're going to talk about both. These can be really, really difficult trades to make, right? These can be really, really hard trades to hold for actual good foundational reasons. It doesn't have anything to do with, being a perma bull, being a perma bear, being any of those things. It's just the way the market is set up for short calls or short call spreads. They can be really, really difficult trades to put on and then to, more importantly, hold. And as I say on the show all the time, you got to know what you sign up for, man. Like, do you understand what you're signing up for? Like, do you understand what you're engaging with? Are you aware of the gimmies? Are you aware of the gotchas? And are you aware of what you are indeed signing up for? When it comes to short calls, I think this surprises a lot of people. I think it's kind of a rite of passage in a lot of ways. When you sell a call, a naked call, or you sell a call spread and you find it difficult to make money later on in the trade, even when you get direction correct, that's a rite of passage, in my opinion. That is something that every trader goes through at one point or another. Now, of course, there's a time and there's a place for short calls and short call spreads in every portfolio, but you just have to understand what they are. You just have to understand the structure of these strategies specifically. And so you can, maybe better recognize, when they might be appropriate for a given situation or for what you're trying to accomplish overall, kind of writ large in your portfolio. So, Ryan, go ahead and bring us into the content here today. So why are these such tough trades? Why are these so difficult? Why is it tough sledding? Well, let's talk about that here for a couple of minutes. So regardless of directional bias in the market, we often have various strategies on playing the market in different ways. But the reality is bearish strategies like short calls and short call spreads can be tough trades. Now, why are they tough trades? Like, why are they difficult trades? Well, I'm going to give a reason, or at least a couple of reasons for both strategies. One side of the market is the short call, so there'll be the undefined risk kind of side of the market, and then we'll talk about short call spreads, which is the defined risk version of a naked short call, of course. And you're going to see that the reasons why the two are difficult are not exactly the same. The Venn diagram doesn't perfectly overlap here. So with short calls, number one, you're going to be fighting positive drift. Right. This is going to be the case for any bearish position you might have on. It could be a short call, it could be short futures, could be short stock, whatever. You are going to be fighting positive drift. And you have all this money that's being put to work every single day, every single week, month, quarter, whatever. You have the natural propensity of the market to go higher and to offer investors and traders positive risk premiums. Like, that is going to be working against you. And so the reality is, if you put a short call on and it's kind of like an in and out type of situation, it's kind of just like a little quick hitter action, then that's one thing. But oftentimes when we put trades on, we have to hold them for a while. Right now, a while doesn't mean multiple years necessarily, but we will oftentimes find ourselves holding a trade for a couple of cycles. So we might be holding a trade for 2, 3, 4 months. That's not that uncommon. It's not the expected move when we put our trades on. We usually are in and out within a matter of maybe 20, let's say 15 to like 35, 45 days. Maybe one roll is going to be, the most we typically have to do on a trade, but there will be times when you have to roll multiple times. There will be times when you have to roll, 2, 3, 4, 5 times on a given position. And if that's the case, the entire time that you're doing that with a strategy like a short call, you are battling against the natural drift, the natural propensity of the market to move higher. That's tough to do, man. That is a tough situation to be in. That is a tough trade to hold because you're naturally fighting against that. And that is, why I'm generally a perma bull. Not this year, of course. This year, I decided for no good reason to flip my cards over and play it from the bearish side. And that was clearly the wrong decision every single day of 2023. But alas, here is where we find ourselves fighting positive drift. And it's very tough to hold. Short calls are really, really difficult trades to make. That's why, you don't see us make these trades very often. We just don't. Not a naked short call all by itself. As part of a strangle, that's something different. Even as part of, a ratio spread, that's a little something different. It's not really that different, but it's at least a little bit something different. We don't typically just sell naked calls and then that's that. What about a short call spread? Well, this is going to be a little bit different, right? There's actually kind of, a gimme associated with a short call spread. When you spread off a short call and turn it into a short call spread, one of the benefits of doing this is you get good entry prices on that spread. And I think even Anton this morning was talking with Tom and Tony about the skew in the marketplace. And he kind of reminded us that skew is always there. Like skew is always watching. Like there's no way around, the skew that exists in the marketplace. That's absolutely true. Well, when you sell something like a call spread, like when you have a short call and then you buy that further out of the money call to define your risk, you're actually using the skew to your favor. You're actually using the skew and putting it in your favor to help to kind of improve the entry price of that strategy, all the while, defining your risk. We're going to look at this in SPY here in just a couple of minutes. However, for every gimme, there's a gotcha, or at least one gotcha, maybe multiple gotchas. When you sell a call or a call spread in this case, when the market goes down, which is what you want, right? This is a bearish strategy. You want the market to fall. You want the market to go down. You want prices lower, all those things. IV is typically expanding when the market does drop like that. And so in a situation like that, if you sell a call or a call spread, this would kind of apply to both strategies. You're short Vega, so you want volatility to go down. So if volatility is actually rising, that's going to be working against you. Right, that's actually going to be hurting your short premium position. And so as a result, you may not be as profitable as you thought you would be at that point. You're like, hey, I got the direction to move right. The market's actually moving lower. And so why am I not getting paid? Why am I not profitable on this strategy? Well, one of the reasons might be the implied volatility expansion that's accompanying that market price drop is actually working against you, leaving you kind of in like a wash type of situation. And that can be really frustrating. That can be very frustrating. It can be a real head scratcher in terms of, hey, what's going on? I don't quite understand what's going on with this strategy specifically, et cetera, et cetera. So short calls, short call spreads, tough trades to make for these couple of reasons. And so it's just critical that you understand what you're signing up for. Just know that when you put these strategies in your portfolio, I'm not saying you shouldn't put them in there. I'm just saying make sure that you understand that this might be more of a tough sled than you were prepared for. So Ryan, go ahead and bring us into the content. Let's take a look at this. I want to show you guys how this works, at least with a call spread with SPY. So let me go in here. Let me share my screen. We'll bring the market back up. So market's stabilizing a little bit down here around 350, the old NASDAQ. ES up there at 42 hundo. And so, crazy stuff. So if I go in here and let's see, if I go to SPY and I go to set up a call spread in here. So let me go into July. In fact, I'll just go ahead and set up both. Like, let's say that you just love pain. Like, let's say that you just really are looking to put yourself in a really, really difficult spot. Well, one of the things you could do is you could sell this 424 call. You could just say, hey, I've been following Dr. Jim. He feels really good about the market going down. I feel really good about Dr. Jim. And so I'm going to play the market lower. Well, you've made a myriad of mistakes in that analysis. But assuming you were to go forward with that analysis, let's say you sell that 424 call, right? This is your short call. Right, this is your situation where you're playing the market lower. You can see it right here. You have some negative delta. And so if the market goes down, like, you are going to be profitable on the trade. But just be aware that if the market goes down really fast and really hard, then the IV expansion that's going to accompany that move lower will be working against you. So you may not be as profitable as you expected that you might be, given that market drop. All the while, you do have positive drift kind of in the background that is likely to kick in at some point. Now, it may kick in, later that day. It may kick in the following day. It may be, 3, 6, 9 months down the road. I mean, nobody really knows when these things are going to happen, with certainty. But this is how you would set up a short call, and it's going to be a challenging trade, in my opinion. So maybe you're thinking, all right, maybe I shouldn't follow Dr. Jim. Well, now you're warming up to the right type of analysis that you should be applying to the market. But let's say that you decide, instead of doing a naked short call, I'm going to do a short call spread. So you sell the 424, and let's say you buy a 428. We're actually missing the 429. I got some missing strikes, people. SPY, sleeping on the job, 427, gone. 429, gone. 431, gone. 433, gone. It's one thing to have janky strikes. It's another thing to have missing strikes entirely. And so that's pretty interesting. I think the bat was responsible for the 427, the 429, the 3133. Those are the bat's responsibility. So it makes sense why they're not there today. But nevertheless, we do a 424 and a 428 short call spread. If you look a little bit more closely at this spread, you can see that how we're taking advantage of the skew in the marketplace is the fact that we're selling implied volatility when it's higher, where I'm selling implied volatility of almost 15%, 14.7. I'm buying implied volatility that's much, much lower, almost a full point lower at 13.8 or 13.9. And so that's going to be, part of the reason, if not a big, chunk of the reason why you're able to sell this spread for such a nice price. I mean, we're in a situation where, the stock is at 419. I mean, not for long, obviously. It's going to be 422 before the market closes today. But right now, it's at 419. You are actually 5 points out of the money with this spread, and you have a pop of 60%. And yet you're being compensated with basically a 50-50 proposition. And so this may look like a really good trade, and that's because in a lot of ways it is a good trade. Right? This is why short call spreads can be a much better alternative than a naked short call. Like, yes, it does have problems. Yes, there are some gotchas associated with this trade, just like, all the things that we've been talking about for the last 5 or 6 or 8 minutes, but it still might be a better option than a naked short call. Okay. Well, when you put this trade on, however, you are getting a good entry price. You are taking advantage of skew. You have these favorable things working in your favor. But if the market does go down, not only are you going to be hit by IV expansion, kind of nullifying the market move lower, but because this is defined risk, it's going to move more slowly anyway, right? That's one of the gotchas with defined risk just in general. And so just something to keep in mind when it comes to short call spreads and short calls. And that is why they are tough trades. So hopefully this makes a little bit of sense for you guys.